Hi everyone, my name is Elheng. I am the founder experience lead here at Grid 110. Grid 110, if you don't know, now you know, provides entrepreneurs with access to community, mentors, and critical resources through no cost, no equity programs. We provide free events just like this so that you can get connected to our community as well as learn more about what we do and what we're doing. Specifically, this event it's called Funding Pathways. The goal essentially is to bring together industry experts to give you an idea about different options of funding. And we're super excited to introduce our speakers today. We're going to start with Mackenzie.
Okay. Hi, everyone. My name is Mackenzie Loy, and as I put in the chat, I am founder and CEO of the New Majority. We aim to make it easier for everyday new majority investors to invest directly into founders who look like them. So when I say every day, that means non-accredited, although we certainly welcome accredited investors as well. And when I say new majority, I mean women, people of color, and LGBTQ. So we're looking to diversify the funder side as well as diversifying the founder side. And as far as funding mechanisms, I talked to a lot of angel investors, but specifically our focus is on equity crowdfunding. And then we have done a little bit of work with debt crowdfunding. So happy to speak on any of those. And then just so everybody else knows, I'm also founder and CEO of another company called the Homemade Marketplace. So it's an online marketplace that offers corporate catering and custom gift boxes, all sourced locally from women, people of color, and LGBTQ entrepreneurs. And I've raised a little bit of funding on that side in the form of a convertible note from DC city government. So happy to chat about being on that side of the table as well. Looking forward to hearing all the questions, speaking with everyone, and getting to know everyone.
We're going to introduce next Rohit Gupta.
Hey everyone, Rohit Gupta. I'm based in Berkeley, California, in the Bay Area. Managing Director of Future Communities Capital. I've been in venture for 15 years. In addition to Future Communities, I run another fund that is our kind of later stage vehicle, as well as I write a ton of personal checks. I tend to focus mainly on early stage investments. So seed, pre-seed is kind of my jam. Love to meet fresh new entrepreneurs, find out what you're doing and see how I can help.
And last but not least, Caitlin.
Hi all, excited to be with you today. My name is Caitlin and I have been at Republic for the past few years. If you're not familiar with what Republic is, we're an investment platform and we really help startups raise across all different stages and utilize a number of different security exemptions. Really similar to Mackenzie, we're looking to democratize access to a private company and just really expand the access that investors have at the end of the day there. So we work with seed all the way up to Series B stage companies, whether they're startup focused, CPG, fintech, sustainable companies are also kind of all of our popular verticals, but we also do have a pretty big stronghold in crypto as well. So helping token projects raises and things like that. But yeah, no, excited to chat more and kind of answer any questions that you might have in the equity crowdfunding industry and kind of just alternative funding pathways as well.
Amazing. Super excited that you guys are here. I love hearing from our speakers because you just have so much knowledge and so much to glean from. So I'm super excited to get started with these questions. So this question we usually ask at every event, mostly because everyone has their own process and thought process. I feel like every investor kind of thinks about investing differently. So I want to ask, at the beginning stage of the founder's fundraising journey, what should a founder do to assess their funding need and the direction in which they plan to take regarding that funding?
I'm more than happy to hop in here. I think that when it comes out to planning out fundraisers, two things that I always look for as like a really good signal of a well thought out and kind of planned raise timeline is exactly what goals you're looking to hit. And then also kind of the valuation range, what you want to stay within. And then also once you hit those goals, like kind of the upgrade of valuation that you see for your company, being able to have an end site in place. So maybe that is getting your product up to the MVP stage. Maybe it's, reaching a certain amount of users, but setting a benchmark and then working backwards from there to understand budget, is really helpful. And then I think that when you tie the valuation into it all, it also does help you address the question of dilution, which obviously is really important when you're fundraising for your company. So, I think that benchmarking and kind of meditating on that beforehand is always a step that, I think is vital for fundraising and planning that out.
Caitlin, so you said a couple of words that I want to kind of break down. So valuation, right? What does valuation and dilution mean in terms of fundraising, and what does it mean to join Republic?
Definitely. So valuation is pretty much just the value that you're putting on your company. It doesn't necessarily need to have to do with any of the kind of like traction or revenue metrics that you're making currently, but just overall pricing the fact of like, if an investor comes in and puts in a certain dollar amount, of how much of a piece of your company that you may be giving up there. So for example, if you have a post-money valuation of 10 million and you're raising a $1 million round, that means that once the round is closed, you'd be giving up 10% of your company overall. Of course, you would hope that at your next round and down the road, you would have a higher valuation than just $10 million. But, whatever piece those investors hold will kind of multiply as the company grows and kind of as you carry along your fundraising timeline. I think that one sentiment I would always put there is, you always need to consider the market landscape and, just kind of how other companies are tracking and raising at the same time too. I think that being in the VC ecosystem for the past few years, we did see a very large peak in valuations kind of in 2020, 2021. And I would say that companies are coming out a lot more conservatively now, just because investors are a lot more price sensitive and reserved when it comes to things like that. Yeah, so that's one thing I would know. And then additionally too, I think it's always helpful to consider the fact of when you're valuing your company, you want to make sure that you're incentivizing investors to come in early and also kind of put their belief in you. And so making sure that you are pricing your company at a place that feels comfortable for you and, definitely fits within like the value that you feel like you're at, but also taking into account that investors are taking risks in terms of getting you to that next stage of funding is really important as well.
Thank you so much for that. Do any of the other speakers want to jump in? The question was, what should a founder do to assess their funding need and the direction that they want to take it in?
Yeah, I Caitlin's spot on, but I think that the couple things that I would add is that when trying to figure out a funding round, it's based off of two things. One is you have to budget how much you need, and really that's ties into the second thing, like how much that money's going to get you. And it's really milestone based. So saying like, okay, I need $1 million to get product in the market, or I need $1 million to market, or I need $1 million, whatever the number is. That's how you sort of figure out how much you need. And then you go back from that to say, okay, well, if I need this much money and I want to sell 10% of my company, what does that funding round look like?
Awesome.
And then
I'm happy to clarify if that's weird.
That makes sense to me, but if anybody does want clarification, I feel like raise your hand in the chat. And just to tack on a couple more thoughts for folks is, I still think that the best source of capital for any company is revenue. And so I think that's going to be your number one, is thinking about, or at least that's how I approach it, is always thinking about like, how can I drive revenue? Because I think that means you have customers, that means somebody wants your product, right? And that's really a good signal as far as growing a business. Other things I think to think about from is, again, kind of what are you looking to do? And I think that was echoed by both Roy and Caitlin. It's like, what's that money going to buy, right? What's going to be the value or the ROI of it? How quickly is that going to come about? And then also, as you're thinking about funding, what else are you looking for? So generally, we're looking for money to do something, right? Are there other ways to do that something? Or if you do have an investor, what skill sets, what connections, what introductions are they going to bring to the table in addition to that funding, so that you're getting a true partner. And I guess maybe that's part of a later conversation on when you're looking at different investors. But I always think about kind of what is also your goal as a company and what are you trying to do? And that will match you a little bit, as well as like, are you looking at debt? Are you looking at equity? Are you looking at grant? Well, non-dilutive is like the second best, I think. Revenue, non-dilutive funding, and then looking elsewhere. But kind of what form of funding is going to be the best for your company at this current stage.
I love that. Thank you, Mackenzie. And just to like kind of like add to that line of questioning, I would say, what are some of the first funding sources they should explore? Because Mackenzie, you hit on some good points: revenue, non-dilutive, and non-dilutive essentially is kind of like grants. Grants you don't have to pay back, you don't have to give away a piece of your company, right? So what are some of the first funding sources they should explore? You mentioned revenue. I feel like that is a funding source that we kind of overlooked, because I know that we need a lot of money as founders when we're first starting out. But what are like the things that we should be looking at? Do you know of any resources recommended? Like, for example, we are a resource. We have grant programs every few times a year. And so any suggestions on that?
One quick suggestion is, so my companies are, well, my Homemade is a B2B company. And so I've actually found LinkedIn to be one of my best kind of forms of marketing, but also connecting with other founders, funders, like people all the time are posting different grant opportunities and things like that. So just following those so that they pop up. You'll see that grant opportunities will often come around same time each year. So if you missed it this year, just flag it for next year. And then I think this was like dancing around your question. I suppose that on like actual grant applications, generally local government, there will be like local chamber of commerce, like, you know, Grid 110 is a great source as well. So get on those e-lists to find those. 1863 Ventures in DC is a great one. But then I also think if you're a solo founder, or if you're a super lean team, if you're working with interns, grants and applications are a great opportunity to onboard folks and kind of hand off some of that heavy lifting, I guess. That's a little bit more rote, because there's, you know, grants in all these applications, whether it's to an accelerator or a pitch competition, it takes time, but it can return. So I've done pitch competitions where I've won 30,000, and that was huge at a really early stage, right? So if you don't apply, you don't get it.
Awesome. So moving into the next question, how do you define traction? Anyone can jump in here. How do you define traction, and what is traction? I feel like there's, again, every investor has their own different type of goalpost, right? For example, like, what does traction mean on Republic, right? I'd like to actually hear from Caitlin on this one, because it's kind of like a crowdfunding. So what is it that investors are looking for on that kind of platform?
Yeah, no, there's definitely a few ways to think about it. I think that when it comes to crowdfunding platforms, there's always going to be two sides of the table that you're looking at in terms of investors, right? So there's Republic's audience, which we've been able to amass, you know, over the course of the 7 years that we've been around, investors who are consistently looking for deals on our platform and in discovery mode for the startups that they want to invest into. On the other side of the coin, though, too, you know, oftentimes companies do bring their own communities and tap into their own communities on our platform as well. The amazing thing about equity crowdfunding, which is what Republic and then also what Mackenzie's company does as well, is that it allows for non-accredited investors. So really, we're talking about minimum investment sizes of about 100. So, you know, sometimes when you're raising privately and doing friends and family rounds or SPVs generally, you know, you have to make sure that you're looking out to include accredited only investors and kind of include a minimum check size that people need to put in. A lot of the times it can be difficult in feeling comfortable and actually going out to your whole network when you are asking, you know, for these larger chunks of money. Equity crowdfunding is great because it really does just widen really who you're able to involve there. So I think, you know, when we are looking for companies to raise on our platform, we always like to have an understanding of a little bit of a community that would be coming in on their end, that they're really excited and have an intention in utilizing. Now, when it comes to traction metrics that our investor base looks for, for the most part, we work with companies that are already in market and either producing revenue, showing growth rates month over month on that, or, showing the other kind of weighted traction metrics that they're looking for. For example, there are a lot of user-based companies that are solely focused on acquiring users at the very beginning, rather than generating revenue and turning on kind of that part of their business model. So we're more than happy to kind of go off of with whatever metrics that make sense. But, it's really helpful to have a few months, if not a year's worth of data to understand how things have been growing over time, really, how founders are able to capitalize the money that they have outstanding, or kind of the revenue that they're reusing to grow their audience, to grow their traction. So that's one thing. We always like to look at past investment, how much money companies have raised in the past, how well they're utilizing it, if there's any big name investors, because for retail investors, oftentimes if they see that there is a name brand VC or a name brand angel investor tied in there, it'll make them feel a lot more comfortable in investing into the opportunity. And then lastly, I'd say there's a lot of weight that is carried based off of the founding team too. If there's a company that has had if there's a company or founding team that has had exits in the past, especially within the same industry, that's always a really exciting signal, and does kind of give confidence to investors as well. So it's a formula of all three of these things. I would say that when it comes to what we look at, we usually like for at least two of the check boxes to be ticked. So for example, we've had companies raise that aren't in market, aren't generating revenue, but they have VC backing and, they have well-known founders standing behind it. Sometimes we've had companies that, maybe aren't as well-known, but do have that kind of historical traction that they've shown in the past that have also raised with us. So it's a combination of those factors, but that's what we find our investors are usually looking for when they're vetting these opportunities.
Awesome. Does anyone want to add on how they define traction? Rohit, we'd love to hear from you.
Yeah, it's a good question. And I feel it's the interesting part of the question is traction is really whatever you can get away with, right? Because if you go to YC Demo Day, all they care about is a hockey stick up and to the right. And they'll say like, well, in 3 weeks, we did X, and 3 weeks doesn't tell a story, but if you can get away with it, and you can extrapolate based on this, where this growth variable and things are looking great, you can get away with it. Do it. And it's sort of like confidence in your own story and your own numbers. What do I look for? I look for something that's like a repeatable sales cycle. So I don't necessarily need hundreds of thousands of dollars in revenue, but if I can sort of understand your customer acquisition, and I can say, okay, well, this team has figured out how to sell to this customer over and over again, I'll bite.
I think I will add one more thing that I think is helpful for founders when they're going out and fundraising. Obviously your time and energy is precious, and fundraising is a very big task, and it's something that you do kind of go through in cycles. Honing in exactly on what an investor's thesis is very important, because a lot of the times you might be chasing down the wrong path when maybe that's an investor that you actually want to be interacting with closer to your Series A or further along and things like that. And so I think that, getting an understanding of generally what a investor or institution looks for in terms of stage, vertical, things like that, and honing that out before you put in, kind of the effort of maybe doing outreach over the course of 2 weeks will really help you save time. So I think kind of being tactical about like where you're putting your time and energy. And then also to like, if you hear feedback from someone of like, hey, maybe it's not the right time right now, but would love to check in when you're raising your Series A, of course, adding that to your Rolodex and making that little note, just so you do have an outreach list of someone you can go back to, really excited, and be like, hey, I'm ready, I'm at this point and would love for you to revisit. So, I think getting an understanding of really what people are looking for is huge as well.
And then maybe to add on to that, I think something that has been echoed is knowing your data and then being able to tell a story with it. And then as you tell that story and as you grow, like evolving that story and like really kind of trying to show momentum and growth. However, as I was saying, however you define that as, whether it is, like Caitlin was saying, users, or if it's revenue, or really great feedback that allowed you to pivot your product, right? But then there was some initial success. So telling that story with momentum. And then something that I try to do is I send out community updates, not necessarily investor updates. And this is something as an investor, I also love to see. And those community updates can just be quick updates, whatever you've defined as your KPIs, although be thoughtful about how you define your KPIs. It should be things that make sense and are actual true KPIs. So share a couple of those, where you're at, where you are, what your ask is. And if you can build a track record with your community, and maybe you had a nice conversation with an angel or a VC that said, talk to me in Series A, like Caitlin mentioned, maybe they go on to this community update and you can start to build like your brand and reputation with them. They may be a very warm investor when you are ready to raise, so that you're not starting from cold, but you've already built your story with them. And now you're just updating them on what your specific ask and where that money is going to go and why you need it today. But if you've done your job right in cultivating those leads, they should know already what you're going to use. And they're like, yes, we're ready to write you a check because we see the value that's going to come from it.
Amazing. So I think this is the $1 million question. When is it time to raise money?
My answer would be, well, okay. So I feel like the best time to go out and look for the money is when you don't need it. That's what I hear as far as, and that's what I think more successful campaigns that I've seen from the equity crowdfunding space. And I'd love to hear your thoughts on that, Caitlin. But I think like when someone really depends on that equity crowdfunding campaign to get to that next step, and like it's all eggs in that one basket, that does not really convey the momentum story that I was talking about earlier. But I also think that we should always be going out to raise because we need it. So like from a timing perspective, it's not just because it's like a badge or it's something that everyone else is doing. Like, so the time is going to be unique to your company and like, what are your goals and what you are trying to do, which is that first question we asked.
Yeah, I definitely agree. I think throughout a company's growth story, there's always going to be times that you need to go and hit the fundraising trail. I think that oftentimes an ideal raise is really when you feel like operationally you've really to that next level, everything's running smoothly and is kind of tracking nicely, but you're looking to kick things up a notch, whether that means, doing a bigger go-to-market push, pushing kind of just like width of sales that you're trying to do, things like that. And I would agree when it comes to equity crowdfunding, like one of the things that people don't necessarily realize is that it is a little bit of a longer process because it does include setup, but then also like your be running lasts for a while because you want to build up momentum, kind of leave the opportunity for people to invest a little bit longer. So all in all, it's a few month long process. So you need to kind of just be conscious of your own bandwidth, capital needs during that time. And if you can kind of comfortably put the dedication towards it.
So my perspective is that founders are always fundraising. It doesn't stop, right? Like a round closes and then we're starting to line up investors for the next round, or there's a bridge. I mean, some of the best folks I know in this game is as soon as the round closes, price round, wherever Series A, B, doesn't matter, they open a safe because there's some people that didn't get in the last round, or, they hear about it. Oh, I love your company. Like, cool, put money in today. I'll take it. No problem. That's kind of the glib answer, but you know, you'll, as a founder, you'll sort of hit these moments. You definitely feel capital constrained, and you want to go out fundraising before you hit that moment, because by then it's like you're losing time. You want to have money in the bank ready to deploy when you hit that sort of moment, and you definitely want to go raise money before it's a crunch. You know, I understand some of you folks are like bootstrap. You never really raise a ton of money, and so you kind of have different sort of parameters on how much you keep in the bank in your runway. But if you're sort of getting down to like 6, 5, 4, 2 months of runway, it's a little late to get going. You know, I had a conversation just the other day with a company. I was like, you can't get down to 2 months and expect to start a fundraise and have this thing done in time. You know, you don't want to be in that situation where you're just hanging on, like hoping people wire and stuff. It's important to sort of have a budget and really work off of that, and not just sort of deploy capital. And these things really come into focus as you get sort of past like series. When you get to your Series A, it becomes vitally important. You'll all see it.
Awesome. We have a few more questions, and then we're going to go into the breakout rooms where if your questions didn't get answered in the chat or in this talk, you'll be able to ask the investors one-on-one. And so another question we have is the state of the current startup funding landscape. I have also been hearing that it is not a good time to raise. Myth or fact? What do you guys think? Is it possible for pre-revenue startups to raise capital in this market? Is this a thing? Help us understand.
These are, so I'll jump in. These are great questions. And if I don't answer it, then Elle, if you could just jump in and be like, you missed a part. There are definitely investors for pre-revenue companies. If you find most pre-seed companies, and I realize metrics are sort of changing over time, but most pre-seed investors expect companies to not have revenue. Some of them don't even have product. I've invested in people with an idea, like pre-website companies. There are investors for that sort of thing. It is a tough fundraising environment. I will agree. Unless you're AI and you can sort of ride the AI train, it's tough out there. And you're going to have to sort of navigate that. But on the flip side, everything's a lot cheaper. Engineering talent is cheaper. Office space is cheaper. Everything is sort of like, you know, scaled down to some degree. And I had another point. Going back to what I was saying earlier about like fundraising timing, when money is cheap, AKA easy, go raise it. There are tons of companies who could have raised money in 2021 who didn't need it and then just didn't raise it. And now they're like, it sucks today, right? When money is easy, take it every single time.
Awesome. Anyone else want to add to that? All right. Now, elements of a successful pitch deck, right? What are you guys looking for when you look at pitch decks? What should you not have on it? What should you have on it? What are like the most, like the non-negotiables of a pitch deck?
Yeah, I think when it comes to pitch decks, I definitely love to see a really coherent and clear outline of problem and solution of what the product is solving, especially when it's at the earlier stages. And then from there, kind of looking at market sizing, things like that, and then back to kind of the original of what I had said when it comes to kind of like deciding on how much you're looking to raise and planning out that fundraising journey. It's really helpful for investors to be able to visualize when companies are able to include timelines of exactly how much it took for them to get to their current stage, how much they're looking to raise, what they want to achieve with that capital, and then also kind of beyond as well. So I really, really like it when I'm seeing timelines and kind of specific goals that companies are looking to hit, and, you know, bonus points if they have been able to hit the goals that they said they would set out to kind of in the past as well. So that's something that is really key in my mind.
I mean, I think that there's like, I feel like a lot of templates for pitch decks, and the core of it is always the same: the problem, the solution, the team, you know, your product, market size, right? What the ask is, what you're going to use the money for. So I think more thinking about where your pitch deck is going. So is it you're sending it out because you're fundraising and you're sending it out to folks who either know you or don't know you? I think you might have a little bit more text on that, a little bit more explanatory, since it's just going along just by itself, versus if you're pitching at a competition where you get a talk track to go alongside it, right? Then you might pare it down in a lot fewer words per slide. And then something that I always like, and I think that's because the new majority audience is the angel curious. They may not have invested before or be kind of in industry. So I always like to make it super, super clear, or like have it be really, really clear on, again, problem, solution, all those things, but like, how do you make money? Just making sure you really answer that question. And it's always, you know, if you can't say your business, or like you can't say these things really clearly in a couple of sentences, and like I don't understand at the end of our conversation what you do, that means that you need to clarify kind of your business and your value prop and how you communicate it. I generally think that if it's so complicated that I didn't get in a couple of sentences, that's not me, that's you. Which sounds a little bit harsh, but something to think about in that kind of elevator pitch aspect, right? You need to be really clear and know when to use lay terms and know when to use your complex industry terms, right? And then the last thing within a pitch deck, I always like to see like the dream big. So what is it that gets you out? Like, that's like, oh man, in 10 years, like it'd be so cool. And we really think we can achieve X, right? And really don't forget to get us excited about your business. And not just like stuck in the numbers, but connect those numbers and data to like this, like the big vision, the big story.
Amazing.
Sorry, I was listening to Mackenzie, just trying to take like mental notes. This is great stuff. I think the few things I would add here, and these are just sort of my own personal things that irritate me. I was just not putting in how much you're raising, because I've had people say, "Oh, I'm raising $500,000,000," and then the fund is like, "Well, I only deploy $1 million." And what would you say no to $1 million? You take it. Right? So you've automatically disqualified people who might have otherwise invested. The other thing is, make sure you have an email address that is the same as your domain. Do not send me something with a Gmail in it. It just looks sloppy, right? What other stuff? I think a pitch deck has got to be it's got to be a cohesive story, and like it's tailored to your audience. But so it's almost like I'm talking to person A, I'm changing my slide and it's not the same as person B, right? Like it is, I hyper tailor these things. I use DocSend. I do not send PDFs of my deck to anybody. There's a ton of services you can use. My friend runs Finta, F-I-N-T-A. You can try that one. There's DocSend, there's SlideShare, whatever. There's a ton of these things. Do something and do not send PDFs. Do not send a sales deck for a pitch, to a VC. I had a guy send me that. I'm like, this is not what your company does. He's like, yeah, but that's my most current deck. I'm like, what are you thinking, man? Like, what are you doing right now? Like you have to be on top of your game. Fundraising is a pain. I do not enjoy it, but it is a necessary part of this world. And if you're not using a CRM, you really should. Do not try and do this off of Google Sheets. Do not try and do maybe Airtable. Do not try and do it out of your inbox. Those are not ways to be successful at this.
I personally love DocSend, and just like an FYI, I'm not a brand ambassador, but I love them because you can like get organized. You can send links to specific domains, like make sure that it's like super protected. Like it's really cool. It's a really great place to have all of your data that's like really important, sensitive, and be able to share it with investors as well. So I would highly recommend checking out DocSend. Yeah. But thank you so much. Those are awesome and very candid points, because it's very important to like not send weird pitch decks or items that have nothing to do with your business. But it is break time.